Hello, this is Richard Walker from Elucidate. In this video, we look at practical applications of Ethereum and Web3 in capital markets. We'll first review blockchain, Ethereum and Bitcoin, recall why they exist and what problems they solve. After that, we'll analyse some possible future solutions in the DeFi space. While all of these solutions will be possible, not all will be practical. Less still might be considered desirable. We'll use this PPD, possible, practical, desirable lens to add some formal rigour to our analysis. This will help us select candidate solutions that offer the best return on investment over the short and medium term. Blockchain is a technology that allows strangers to agree about stuff on the internet. An immutable ledger synchronized over a global network of peer nodes secured by cryptographic hashing and encryption allows strangers to 100% agree on everything on the ledger without recourse to a trusted centralized third party. This decentralized proof can be provided at a far lower cost than centralized trust. Ethereum is a global supercomputer. Decentralized apps, or dApps, are built using the Solidity programming language. These connect smart contracts that automatically execute based on trigger events. The results of these smart contract executions can, of course, be anything, but most interest has naturally centered around movements of cryptocurrency between accounts. This automatic transfer of funds between parties will also be our focus in this video. Bitcoin is a payment system. Its original design goal was to allow small, casual transactions to take place on the internet. Bitcoin makes use of the strangers agreeing about stuff on the internet features of blockchain. This allows the secure, provable movement of Bitcoin between parties. By replacing expensive, centralized trust with inexpensive, decentralized proof, Bitcoin achieves its objective of allowing small, casual transactions. Capital markets perform two crucial functions: financing and risk management. Firstly, they put savings to work by channeling them into productive investments. Secondly, they shift risks in variable costs of production to firms better able to manage them. Put in a much simpler way, most corporations have exposures to fluctuating interest rates, FX rates, agricultural, commodity or energy prices. These corporations can use derivatives to eliminate these risks by passing them on to an investment firm. The corporation can thus focus on running its business without having to be concerned with fluctuating costs of production, while the asset management firm can seek to use these instruments to generate a return for its investors. Financing and risk management are offered by large firms using trust networks. This trust legitimately requires levels of regulation, compliance, risk management, and operational control. The staff performing these roles are highly qualified and often accredited. They're consequently legitimately well compensated. All of this adds to the cost of the provision of these financial services. It's unsurprising then that these financing and risk management services are only offered to the largest corporations served by the largest banks and investment firms. The benefits of capital markets are thus enjoyed only by a small number of large firms, serviced by a small number of large banks. Let's begin our analysis by looking at some representative but diverse uses of DeFi. We'll look at using Ethereum to replace an existing solution. That is to say, a replacement product in an already existing market with established suppliers and consumers. Then we'll contrast that with an entrance into a currently unserved market. That's to say, applying an existing product but written in a smart contract for a new set of consumers. We'll consider 4 use cases. Firstly, a currency. Secondly, securitization. Thirdly, derivatives. And finally, infrastructure, specifically a clearinghouse. Arguably, the very first Web3 application of blockchain was a currency, Bitcoin. So it's evidently possible to pass value from one entity to another securely using cryptographic proof rather than branded trust. Cryptocurrency also has the desirable properties of being pseudo-anonymous, open and relatively fast to settle. There are some clear practical concerns though. While high price volatility makes crypto attractive as a speculative commodity, the same volatility renders tokens less useful as a store and transfer of value. A novel approach to cryptocurrencies might be a central bank digital currency, or CDBC. Indeed, many central banks are reviewing, evaluating, or developing such technology. There's clearly a centralised controlling entity, so the benefits of a trustless, decentralised approach are perhaps in some implementations moot, but CDBCs open up the possibilities of a programmable currency. It could offer discounts to specific individuals, increased spending power in certain outlets or in specific regions. CDBCs could encourage spending by being burned after a time period has elapsed, or encourage saving by being worth more after a certain time. They give central bankers a means of offering much more targeted monetary policy, focusing on sectors in the economy, regions in a country, even individual products and services that a central bank seeks to support. Cryptocurrencies are therefore desirable, but at the moment, frankly, don't pass the practicality test as a currency. Clearly, they do pass the practicality test as a speculative investment. Despite the efforts by Dell and Tesla, tokens remain a niche currency, 14 years after introduction. CDBCs, on the other hand, are evidently practical and desirable. In the early 1980s, collateralized mortgage obligations, or CMOs, became very popular. Louis Ranieri and Larry Fink noted that the most liquid debt market in the world was the US mortgage market. They realized that there was a way to use streams of mortgage payments to offer a spectrum of fixed income returns, from rock solid, low yielding products to very risky instruments offering very high returns. These different products with different risk profiles could therefore be sold to a broad range of investors. Mortgages have a unique set of risks. Homeowners may pay off loans early, forcing lenders to potentially reloan returned money at lower rates. Also, unlike regular loans that accrue interest and return principal at the end of the loan, mortgages have regular payments of interest and principal every month. As with all loans, there's clearly a risk that the borrower will default. All these phenomena lead to reinvestment, default, and prepayment risk on behalf of the lender. A CMO takes a group of mortgages and puts them in a common pool. Purchasers of the CMO will receive the interest and principal payments made by the homeowners into the pool. This pool is further grouped typically into 4 tranches, with the riskiest equity tranche followed by the less risky mezzanine, and then junior and senior tranches. These tranches are aligned to risk. On a default risk alignment, the first mortgages to default are included in the equity tranche and the last in the senior tranche. This means that the cash flows paid out in the equity tranche are much likely to be lower. Investors will pay less for this tranche than for the more senior tranches. If no homeowners in the equity pool default, then the equity investors will get a greater return. But In this example, if 3% or more default on their mortgages, then the equity investment will be wiped out. If instead we look at a prepayment risk axis, then the first home loans to pay down principal will be included in the equity tranche. Investors in this tranche are therefore short a prepayment option. The loan will amortise faster, and investors in this equity will receive fewer cash flows. They're also exposed to reinvestment risk on the funds received early. So in both cases, the equity tranches will be priced lower than the more senior claims, but they clearly offer a greater return should homeowners not default nor pay down early. Any instrument with complex but programmable rules, such as a CMO, can easily be implemented as a smart contract. Mortgages are a really good example because of all the rules and all the logic around pooling and tranching along different risk axes. But they're clearly not the only examples. CMOs come with complex and expensive risk disclosures that might be more understandable and testable as code on a blockchain. It's therefore both practical and desirable to look at implementing securitized products as smart contracts. More intriguing still is the opportunity to bring analogous products to fresh markets. The original CMOs required the pooling of thousands of mortgages to be able to overcome the frictional costs associated with trust. But provide these products on a provable blockchain, and smaller, novel payment streams can be economically pooled and tranched in a manner similar to CMOs. Financial derivatives such as interest rate swaps, discussed in detail in previous videos, have sets of rules for converting their contract parameters into series of cash flows. Smart contracts can be programmed to make the periodic payments calculated by the swap. Even better, an enhanced swap contract could make daily or even intraday variation margin payments between swap counterparties. However, it should be noted that swaps are currently centrally cleared, they're highly liquid, and have many ancillary services such as compression and confirmation that would need to be replicated. Marginal gains, such as automatic payments of VM, perhaps fit the category of practical but undesirable. But the opportunity to allow casual hedging between counterparties is both possible and practical. Let's look at an admittedly contrived example, but one that serves to show what is possible. Lucy Date has an ice cream franchise for the Wimbledon tennis tournament. If the weather remains warm and dry, she expects to generate a decent return on the cost of the franchise. At the same time, Claude Ty has a consignment of branded fleeces to sell at the All England Tennis Club. He's hoping that the English summer runs true to form, the weather is cold and there's plenty of emergency demand for his products. The daily profit and loss forecast as a function of midday temperature on centre court is shown in the graph. Clearly, if temperatures rise, Lucy would expect to sell more ice cream. Sadly for her, if the mercury falls, then so do her profits. Claude has the opposite exposure to the weather. Hot weather will cause him to make a loss, but mild or cold weather will see his income rise. A smart contract weather derivative could simply be written allowing exchange of tokens or cash between both parties. If Lucy agrees to pay Claude £1,500 for every degree that the midday temperature is above 22.5 degrees on centre court, and Claude agrees to pay the same amount to Lucy for every degree that the temperature is below 22.5 degrees, then there's a broad range of temperatures that will see them both make a profit. Sure, each one will give up some upside, but this arrangement makes both businesses a sound and worthwhile venture. A few lines of code in a smart contract has a tiny fraction of the traditional cost of providing these derivative services. How desirable this is is a legitimate subject of debate. If the amounts at stake in these derivatives is large and the risks are complex, then this may be highly undesirable. But for small amounts exchanged and for simple risks, these types of products could bring very effective business insurance to parts of the market that are currently unserved. In the last video, we looked at derivatives infrastructure, specifically clearinghouses. These clearinghouses operate a set of rules for checking trade eligibility, calculating initial margin and default fund contributions, and for making frequent exchanges of variation margin. All of these rules could easily be implemented as a smart contract. However, smart contracts are automatic. They have no discretion. If, for instance, Deutsche Bank missed a margin call through some operational outage, would you want to put them automatically into default? No, definitely not. You'd first want to make inquiries before such a precipitous decision. Here's where higher cost, human-in-the-loop service is appropriate. The costs of all the intermediary layers have a role to play in this specific scenario. But what if this is a lower cost, lower risk, lower impact market? Perhaps the casual derivatives between Lucy and Claude we were just discussing. Wouldn't that market and other markets like it benefit enormously from a low cost, non-discretionary clearing solution? Now, in this scenario, the rules of the game are strict. They are rigorously and consistently enforced by a smart contract. If you fail to uphold your end of the deal, you will suffer the consequences. There's no discretion and no recourse. But this, for many markets, is evidently a price worth paying to get the safety and benefits of infrastructure services like clearing. So if you followed and agreed with this analysis, then there's a very, very clear conclusion. In every single case that we've considered, the benefits of Web3 and DeFi are not greatest when replacing an existing product or service with a smart contract. In all cases we have looked at, the greater benefit is taking what has worked in the human-in-the-loop market with its small number of large firms and deploying these services in an automated mass market with a much, much larger number of smaller actors. Despite these conclusions, there are many ambitious DeFi projects that seek to replace and unseat established product markets. We wish them well, and several may succeed in time. But the greater opportunity in the short term, at least as far as Lucidate is concerned, is to take what we've learned in wholesale, high-cost, human-in-the-loop markets and deploy relevant pieces in retail mass markets. Ethereum allows the benefits of financing and risk management to reach a far wider audience. This is Richard Walker from Lucidate. Many thanks for watching this video. We've looked at the benefits of blockchain and Ethereum. Blockchain allows strangers to agree about stuff on the internet, and Ethereum is a global supercomputer to facilitate the transfer of funds given rules and triggers. We've also looked at the financing and risk management benefits of capital markets. In looking at several examples of financial products, currencies, securitization, derivatives, and clearing infrastructure, we've concluded that the best opportunities in the DeFi space are the provision of new services to mass markets rather than the replacement of services in wholesale markets. To hear more about how Lucidate can help with Web3, DeFi, or artificial intelligence, please visit Lucidate at www.lucidate.co.uk or contact us via any means on your screen.